Hi, my name is Gabriel Gonzalez. I'm a mining analyst at Echelon Capital Markets, a Toronto-based boutique investment bank and securities dealer. I'm pleased to have Doug Ramshaw, the president of Minera Alamos, a TSX Venture-listed near-term gold producer, joining us as part of a series of Echelon Capital Markets question and answer updates with noteworthy mining companies. Thanks for being with us today, Doug.
Yeah, it's good to be with you, Gabriel. Thank you.
Thank you. Could you begin by telling us what Minera Alamos's vision is as a company?
Yeah, absolutely. We're a gold developer right now, but have very short-term aspirations of joining the ranks of gold producer. But we don't want to stop with just one project. We have a pipeline of a second project right now and looking to add to it. So, unlike a lot of 50,000 ounce a year producers will want to be bigger, I think we have the operating team and a pipeline in mind that we can really join the ranks of bigger production stories in due course. So very excited for this year.
And as an emerging company, was there a particular catalyst or set of opportunities that you saw in the market, either in the price of commodities or the market, that led to Minera Alamos' formation in 2016? And how has your strategy evolved over the years?
Yeah, we're very fortunate in that we, in an industry that doesn't seem to want to build, but want to discover stuff that hopefully someone else wants to build. Our team is an operating team, and more importantly, it's a cohesive operating team that's been together for roughly 12 years now, focused in Mexico. So, the origins of this came from applying a business model that had worked in the past. The team were very much the key members of the Castle Gold group that built a mine, expanded the mine, and ultimately were taken over by Argonaut Gold. And so, the plan was Mexico's a great environment. We've got a team there that understand the country and understand the opportunities that presented itself. So we've just basically, once through a merger and now augmenting it as we see fit, been able to establish a group of gold-focused assets down there, all of which are near-term kind of development production opportunities.
So speaking of Castle Gold, it's fair to say that you've been down this road before.
Yeah, for sure. I mean, that mine, Darren and the team, I mean, the three key members I always like to think in our team are Darren Kernigan, our CEO, Federico Alvarez, our VP Operations, and Miguel Cardona, our VP Exploration, because those were the three that designed, built, ran, and then expanded the resource to expand the mine itself, the El Castillo project. And they did that really, went into production right around the time of the GFC or just before it in 2008. So by late 2009, early 2010, where the project was a great success and had been advancing forward, Argonaut came along and made an offer, and it was, I think, easier at that point with what was going on in the financial markets for certain key shareholders to support that approach. In reality, I think when you see the valuations that Argonaut went to, a lot of money was left on the table. So, there's every intention this time, as I think there was originally, to look at building a base and then continue to build the company off that base.
So let's first talk about the Santana Project, which will be the company's first mine into production. Can you tell us what about the Santana Project makes it such a straightforward operation to put into production? Whether it's geology, permitting, just what you saw in that project that has allowed you to bring it rapidly into production?
Yeah, it's a function of a number of things. We're fortunate in northern Mexico where we are, and in Mexico in general, the permitting process is actually a very transparent one, and it's a rapid one as well. We start to finish typically around 12 months. So, Santana had been in the hands of another company where it hadn't been drilled since 2011. The previous management team were moving on to other activities in the capital markets. And so there hadn't been a lot of understanding in recent years as to what they were sitting on. But what that previous team had done was a tremendous amount of work. Close to 30,000 meters of drilling property wide, 20,000 or so meters of that in the first of a number of targets that we have, and it will represent the first open pit. So there was a very robust drilled off but internal resource. It's not 43-101 compliant, but it's been drilled off on close to 35 meter centers, so very robust. The other thing that that group had initiated, excuse me, but hadn't completed all of it, was a large-scale metallurgical test. Santana is an open pit heap leach project. In many ways, the two critical areas to have comfort on in heap leach is your grade reconciliation. Having a solid resource will help that. And secondly, the metallurgical characteristics of this ore you want to leach. And in the case of the predecessor company, they initiated this 50,000 ton bulk heap leach test. So, I think we've got far more metallurgical data than if we'd done 20 or 30 bottle roll tests and a couple of columns. Column tests. We've actually seen how this ore leaches in the environment in a full, in a small scale but significant pad. So that, coupled with the permitting that was going to be pretty straightforward, really alongside a very low capex, allowed us to initiate Santana with a plan that it was kind of that starter motor to get up and running, sub 10 million Canadian capex. That meant that when it came to our second project, we don't mind taking on debt if we're cash flowing at the first operation. What we didn't want to be was a single asset company taking on debt in the wrong point of the market cycle. Right now, probably not the wrong point, but that's been crippling for companies in the past who have just unfortunately not met with technical challenges, met with timing challenges at that.
So you're fully funded to initial production, and you mentioned capital expenditure estimate of only $10 million Canadian, which is remarkably low. Can you describe what that builds in terms of initial production?
Yeah, absolutely. And when I first would talk about our capex numbers, I would get a lot of eyeball rolling back across the table. And I'm thankful in many ways that I can talk to the Castle Gold story, even though I'd rather look to the future and not think about the past. But that's exactly what they did at Castle Gold. And in many ways, Santana and how we're going to start it up and running is a bit of a carbon copy from a cost structure to the El Castillo project, albeit with slightly higher grade than El Castillo, and definitely in a better gold price environment, it would appear. So the 10 million build, which we built a 25,000 ounce a year operation for less than 10 million in the past, the reason it's so low is heap leach. In many ways, it's an earth-moving exercise, and most of your capital cost is really the earthworks associated with constructing your heap leach pad, your ponds, and thereafter it's a small in-house plant design we have, because we're not actually producing doré at site. So instead, just like at El Castillo, we will send loaded carbon to a place actually in Idaho in the US, Metals Research. And for somewhere in the range of, sub $10 an ounce, we can ship and strip that gold and then send to a refinery of our choice in America, and or anywhere for that matter. Now, there are a lot of advantages to that. This is, obviously you save the upfront cost of building your ADR at site, but also, and I will add, that Mexico, for all the benefits of the geology and that mineral potential and the transparent and real clear visibility on permitting timelines, the country has, certain issues, certainly in the south of the country where we aren't, It's a bit more of the wild, wild west with the cartel action down there. Even in Sonora, which I like to think is kind of the Nevada of Mexico, though far removed from what Nevada is, out of an abundance of caution, you have to take precautions. If you are producing doré at site, your security costs would go up more than the cost of us shipping a much more benign material and loaded carbon to the States for stripping. So we actually get a saving on our op costs too. And so I always say Darren comes up with these elegant solutions to remove a capital expense. We're in a capital intensive business. Any extra capital that you're having to spend, is more shares, and more dilution for your shareholders. So we're basically just following a tried and tested approach. And heap leach, especially with the grades we're working with in Mexico, allows you to build these things very modularly. So it will be 25,000 ounces a year, roughly in year one. And then we'll scale up to, and that first production will probably be sometime in Q1 of 2021. We're hoping to commence mining right around the end of this year. So 2021, a modest 25, perhaps 30,000 ounce a year production profile, but it can expand very rapidly. And so we'll look to get it to 45, 50,000 ounces a year, probably sometime in year 2 of production.
And thinking about a topic that's on pretty much everybody's mind right now, COVID-19, has the pandemic impacted Minera Alamos' development timeline at Santana? How are you managing the COVID pandemic?
It did, moderately, in that we had guided at the beginning of the year 6 to 8 months on construction. And that would have had us starting mining kind of early Q4. And we've now addressed to the market that we're probably going to be on the upper end of that guidance. And so, there was a couple of months where we had some delays for sure. Work's just kind of getting going again there as Mexico kind of lifts some of their rules on mining and related activities. The good news is, the delay really wasn't as bad as that, in that much of the work that was going on for this first part of the year was preparing the pad space there, and the local community was still taking down the larger trees and stuff, and taking the wood, which they're allowed, in advance of us coming in with the bulldozers and heavy equipment, which is all at site, to kind of finish off pad preparation before the liner goes down. And so we didn't really lose too much time. We used it to do a lot of pit optimization studies and other minor fabrication that was needed. The issue really is it does push certain of our construction into the rainy season. And just like you can mine in the rainy season, you can construct as well. It's not perfect. And it really, whether we're mining perhaps ahead of our new schedule or not, will be a function of the rain. So we prefer to err on the side of being conservative, and say that mining will start probably around year end now, as opposed to earlier in the quarter. If there's not much of a rainy season this year, maybe we'll surprise. I like to surprise.
So you mentioned the La Fortuna PEA, and it's estimated an after-tax internal rate of return of 93% at a gold price of only $1,250 per ounce. How much better can the project become at a price of $1,700 per ounce? Is there a scope for increased production by potentially lowering the cutoff grade? How can you play around with high gold price?
Yeah, absolutely. I mean, I think what you see in this business is that when gold prices rise, your all-in sustaining costs creep as well. And it's not because of suddenly the operations are poorly run. It's a cash flow, delta kind of argument that, with the rising gold price, your cutoff is dropping, and as a consequence, you're bringing more ounces in, but you might have a little bit more strip ratio to factor in, and so, but your margin overall will increase. So, at $1,700 gold, there's, with all our operations, it will increase the overall resources, and so we could take advantage of a higher throughput. That PEA goes for 1,100 ton a day through a mill that we already own. It's got to be moved down to Mexico, but the mill that we have is a 2,000 ton a day mill. So, there's a lot of excess capacity there that we could definitely take advantage of. I like the fact that we used $1,250, and it was easier to kind of argue that in a $1,500 gold market, that we're trying to be prudent. We're trying to show that our business plan works exceptionally well in a low gold price environment. In reality now, I doubt we'd use $1,250, but we want to build a business model here that's not predicated on needing higher gold prices. We'll certainly take advantage of them. And I think probably the one thing we really take advantage on right now is the good fortune of where we are with this cycle. There are a lot of our developer peer groups that are 18 months away from making a construction decision, 3 years away from production. We can be taking advantage of these gold prices 8 months from now, and that I think is really what's going to solidify our presence and what we're going to be able to do with the kind of cash flow that our projects would spit off at the 1700s and higher, hopefully.
I think the future looks very positive for you and Minera Alamos. Thank you very much for taking the time to be with us today, Doug.
It was my pleasure, Gabriel. Thanks so much.
This has been Gabriel Gonzalez for Echelon Capital Markets, a part of Echelon Wealth Partners, with Doug Ramshaw, president of Minera Alamos.